So this week has been absolutely bananas. The beginning of the week, we had a sloppy auction, which then sent yields going higher. And speaking of sloppy, has anybody caught the news on former President Donald Trump? He was found guilty in the hush money trial, and that leads me to believe that, Donald, if you just used Bitcoin, would we really be in this situation right now? Which then begs the question of, maybe there really is a use case for Bitcoin. Following this, earnings have been kind of all over the place, really more to the downward side, especially when we talk about companies like Workday, MongoDB, and CRM. These SaaS businesses are looking like something's going on with the labor market here. Are we now really starting to see a slowdown in hiring? And are we starting to see a slowdown in investments for those medium-sized to small-sized businesses? Which I believe could be a massive buying opportunities for companies like CRM. I wouldn't say right now, I would wait until we see what the labor market does, because if this labor market does tip over, I guarantee you're going to get these stocks a lot cheaper. And if the market wasn't choppy enough with all this data, we just got hit with another piece of data that wasn't digested well by the market. PMI came in below 40. It actually came in at 35.4, which is a 4-year low. If you're not familiar with PMI, this is Producer Managers Index. This is a survey and data collection from many different industries, specifically in the Chicago area, because this was Chicago PMI. That is showing we're heading more into contraction than expansion, even though everything looks like expansion, which is just making this market even more confusing. By the way, if you're new to the channel, welcome in. My name is Colton. We do bottoms-up fundamental analysis on this channel and really dig into the numbers and opportunities that the stock market has to offer. So what I want to do is just take a step back and think about the opportunities that may be presenting themselves, things that we could be overlooking here, and areas that we may want to avoid. So what you have in front of you right now is a 5-year chart of the 10-year treasury, and this is what we all live off of. Whether it's credit card debt, buying homes, we're a debt-based system, so the cost of that debt is definitely going to be the topic of conversation here. Multiple reasons why we need to be buying companies with clean balance sheets right now. As we're issuing more and more debt, we're starting to see sloppier buying performance when we look at what's going on with the 10-year treasury and longer out. This is clearly an uptrend that's formulating here, and I do believe that yields could fall substantially and we would still be in somewhat of a bullish uptrend, which is telling me from a technical analysis that it looks like yields are going to be remaining elevated for longer. And when we top of that with the amount of debt that's being issued, even if feds do lower rates on the short end, I do believe there's going to be a substantial bid on the long end, staying above 3%. And so while we're getting that spike in yields, what are we noticing? Well, this black trend line here that I just put underneath, the one that is now in a downtrend, is going to be realty income. And we can use almost any sort of REIT on here. Office REITs in particular are going to be in a tough situation. We're starting to see many businesses close down shop. We're starting to see yields spike, which means that free cash flow on a lot of these companies when the debt maturity is coming is going to start shrinking as the years progress, especially if these yields do stay pretty high. Now, of course, this all would change if we saw yields come back down, but this is going to weigh heavily on the office REITs in particular. And when I look at the debt scheduling, realty income is one that I would wait a little bit longer on. I actually like the debt maturities a little bit better for a company like Vici. The problem is Vici is really tied to the consumer, and it's going to perform based on consumption. We're starting to see that consumer slow down. We could see traffic for airfare slow down, which then could impact a company like Vici. But from a debt maturity standpoint, I do think that their profile is a little less risky right now. A lot of their debt's due 5-6 years out, while some of the debt that's due for realty income is in the next 1 to 4 years. So we've kind of been following the debt maturities on these types of companies. We've been staying back because they just are in a clear downtrend right now, and it doesn't make sense from a macro standpoint to really take the risk on, especially the uncertainty with real estate, which is then going to lead us to other opportunities. I believe that this has been a generational buying opportunity when we talk about healthcare, at Johnson & Johnson, down to a Pfizer, down to a CVS, down to a Bristol-Myers Squibb. All these pay pretty substantial dividend yields that are pushing over 4%. Some are even as close as 6%. And I do believe that their earnings are fairly stable, even if we go into a downturn. If you were looking to add yield into your portfolio, I believe we're in the part of the cycle where this makes a lot of sense to add yield for multiple reasons. Number one is dividends can be overrated, but if they have earnings growth, you have a compounder here. which means if a company keeps raising their dividend consistently and they keep growing their earnings consistently, you probably have a very strong stock in this market right now, especially if the multiple makes sense. Now, one of the areas we want to talk about, consumer staples, is definitely in a turnaround period, but I do think they are going to be a buy very soon because I think we're heading into deflation and prices are eventually going to stabilize, which means their margins are going to get back under control. And we only have to look as close as Hormel Foods. Hormel Foods is down nearly 20% on the year, and this is a stock that really doesn't move a lot. This is always a staple in a lot of dividend portfolios, but it always has traded for a premium. And what I've noticed about Hormel Foods is the earnings growth is not there and the market is starting to catch on here. You need to have earnings growth in order to sustain a high inflationary market. And we're seeing companies that pay dividends and don't have earnings growth really fall down here, and Hormel Foods is no outlier. Now, I did a video on Hormel Foods, and I do think in that mid-20s starts getting really, really interesting here. I'd probably wait to around $26, $27 if it ever gets to those levels. I do think that they're going to finally stabilize. They'll get their margins under control. Free cash flow will get a little bit better. And this is obviously a company that's probably not going to go out of business anytime soon. Now, if they don't get earnings growth, I would be a little bit concerned about this dividend yield. To me, it's at a pretty substantial high ratio. They're not really able to invest more into the business. They're not really able to do mergers and acquisitions without taking on debt because they are committed to this dividend, and that does become a problem. But if you want to look at an impressive track record, 57 years of paying out a dividend and 57 years of growth, the question becomes, at what price do we pay for Hormel Foods? And this is where I do think we have to look at closer to the mid-20s here for us to be taking on risk, because I do think that there's better opportunities in the market, and healthcare being one of those sectors. Now, one company I'm waiting to report earnings is another dividend stock here, and that's going to be Smuckers, ticker symbol SJM, paying dividends for 23 years, raising those dividends for 23 years. This is another one that's dealing with high inflation and some issues, but recently has made some mergers. And so I'm looking for this earnings report. I'm actually looking for a sell-off, believe it or not. I'm hoping this company sells off so I can build a substantial position more longer term, and I'll explain my reasoning here. I definitely want to get this closer to the 90s because when I look at it from a DCF model, I can see it sitting anywhere between $100 to $120, which definitely makes it a buy right now. But when I look at a multiple of EBITDA, I do think it's probably closer to an $80 to $90 stock. So therefore, I'd like to get it into the low to high 90s if possible. This definitely has a strong bid around $100 a share, so maybe it won't break below those levels. And I believe that future growth is actually going to be coming in the form of coffee. As we saw by Starbucks' earnings, it looks like the consumer is slowing down and things are going to be done more at home, in my personal opinion, which means that those $7, $8 lattes are now going to be Cafe Bustelo, Dunkin' brands, and things that we make at home, saving substantial money for the consumer, but putting Smuckers at the top of the list when we look at home consumption coffee. So this one's uniquely positioned. I'm just waiting for that opportunity to present itself, and I do think we could see it sell off at earnings. As we saw by Hormel Foods, the response was down 10%. Could we get a 10% pullback in a company like Smuckers? So for our masterclass on a live stream, we're probably going to do an update both on Salesforce and Smuckers. Smuckers reports earnings next week. We'll probably give it a day or two, and the following week we will go live, go over Smuckers earning, and talk a little bit about Salesforce, where it might make sense to possibly take on the risk for this very innovative company that recently has sold off pretty drastically. As always, ladies and gentlemen, appreciate your time. We will see you in the next one.